The International Energy Agency issued a warning earlier this week that the fourth quarter will see a worsening of the deficit on the oil markets. The cause? Recently extended cuts by Saudi Arabia and Russia through the end of the year. Although the deficit could still get worse, it is already hurting energy users and reigniting inflation. It happened right when central banks believed they had it under control. One current example is the most recent inflation data from the United States. Energy prices increased by 10.6%, which pushed overall inflation to a 3.7% annual rate in August. Core inflation increased by 4.3% annually, fueling hopes that the Fed would change its mind about not continuing to raise interest rates. These inflation rates demonstrate how fragile any economic equilibrium is when the energy markets are out of balance, even in the largest economy in the world. They also demonstrate that predictions of an impending peak in oil consumption should be treated with caution. This week, the Wall Street Journal reported that rising gasoline prices are having a negative impact on U.S. sectors that depend on hydrocarbons. Due to rising fuel prices, particularly for diesel, the construction, transportation, and farming industries are all hurting. For all the ambition that EV proponents show, there are yet no viable electric truck alternatives to diesel-powered vehicles that are large enough, affordable enough, or practical enough for farmers, freighters, and builders. The recent increase in crude oil prices is mostly to blame for the price increase in gasoline. However, the issue is worse with diesel fuel. Middle distillates, such as gasoline, heating oil, and diesel, have significantly lower global stockpiles than they typically do at this time of year. Additionally, there is insufficient refinery capacity to make things better. There isn't enough sour crude either. According to Reuters' John Kemp, distillate fuel stockpiles in the United States were 16% lower in August of this year than the 10-year seasonal average. The equivalent in barrels is 23 million for that 16%. In contrast, intermediate distillate inventories in Europe for August were 8% lower than the 10-year average. The equivalent of 35 million barrels is that 8%. Even though, and this is maybe the most alarming part, industrial activity in most major consumers, including the US and Europe, slowed down throughout the time, the decline has been mounting for the majority of the year. The issue was undoubtedly made worse by Saudi Arabia's announced production reduction in the summer. The Saudis mostly curtailed heavier crude grades used to produce middle distillates. Russia also reduced exports. The fact that there aren't enough refineries is another factor in the world's middle distillate stockpiles being so much lower than usual. The issue is particularly severe in Europe and North America, where several refineries were shut down due to the pandemic and others were transformed into facilities for the production of biofuels. The remaining capacity seems to be enough to produce gasoline in response to demand, but it is insufficient to meet demand for diesel fuel and other intermediate distillates. All of this indicates that the suffering experienced by European and American freight transport companies won't soon abate. As the heating season approaches and fuel oil consumption rises, it might even get worse. Businesses won't be the only ones feeling the squeeze. The Biden administration has already expressed concern about the increase in gas prices and has made contact with the oil sector to, supposedly, take action. In response to the American Petroleum Institute, the industry essentially gave a flat no. The Biden administration has instead used every chance to limit output both now and in the future, despite the fact that it is obvious that America needs greater energy production to meet unprecedented levels of demand, according to the advocacy group's senior VP of Policy, Economics, and Regulatory Affairs, as reported by Axios. President Biden promised to lower costs when West Texas Intermediate hit $90 per barrel on Thursday. The strategic petroleum stockpile is already halfway depleted, which is a worry. Biden cannot, therefore, replicate the significant decrease he employed to stabilize prices last year. In a recent speech, the US president pledged, "I'm going to bring those gas prices down again." But compared to previous year, his options are even more constrained. He then had a complete SPR. The SPR is currently at a 40-year low. No one will be happy with a new round of drawdowns. There is no chance that producers will increase production quickly enough. Even if they do, it won't be the production of sour, heavy crudes utilized in the manufacture of distillate fuel by some miracle. In other words, the suffering will continue, much with the output cuts in Saudi Arabia and Russia. Unless the administration completely eliminates all sanctions against PDVSA of Venezuela. This will allow for the addition of heavy crude to Canadian supply from another source. Crude oil prices were set for a third consecutive week of gains today, supported by the widening gap between supply and demand as well as China's most recent industrial output data, which revealed stronger than anticipated growth in August. At the time of this recording, Brent crude was trading at $94 per barrel, while West Texas Intermediate was just above the $91 per barrel threshold. When it was revealed that Chinese refiners set new records for refining rates in August, optimism only grew. According to official statistics data, they handled 15.23 million barrels on average every day, which is a 19.6% increase from the previous year. However, the Saudi Arabian and Russian organized production cutoff continues to be the main cause of the price increase. In its most recent monthly report, the International Energy Agency issued a warning that cuts would cause the oil market to become even more unbalanced in the fourth quarter. The IEA predicted the peak oil demand before 2030 at the same time, which provoked an urgent response from OPEC. As the International Energy Agency asserted earlier this week, peak demand for oil and other fossil fuels will not occur before 2030, according to reliable database estimates, the Organization of the Petroleum Exporting Countries OPEC said on Thursday. It also rejected suggestions that this marks the beginning of the end of fossil fuels. Indeed, there have been many alerts recently concerning the peak oil consumption, all predicated on EV penetration rates that haven't happened yet. Instead, according to the IEA itself, global oil demand has risen steadily and reached a new high this year. Additionally, the oil trade is growing in popularity. Oil betting is becoming a popular trade on Wall Street. There is no question that the OPEC Plus decision at the end of last month will keep the oil market extremely tight in the fourth quarter, according to Oanda analyst Edward Moya, who spoke to Reuters. According to Ben Cahill, senior scholar at the Center for Strategic International Studies, the market appears much tighter as we reach the fourth quarter. It appears that we are approaching a sizable supply deficit as a result of the OPEC Plus production cuts, which bodes well for price growth. Along with rising prices, the IEA has cautioned that OPEC Plus production cutbacks have created the conditions for further volatility because the world's oil inventories are being depleted and OPEC members are developing spare capacity. Early Asian trade on Monday saw an increase in oil prices as investors anticipated a tighter market and hoped that China's most recent stimulus measures would revive the economy. Early on Monday morning in Asian trading, WTI crude prices were trading at $91.50 a barrel, up 0.85%. Brent crude, the global benchmark, was trading 0.69% higher at $94.57 a barrel and was above the $94 threshold. Oil prices have been buoyed in recent weeks by declining global stocks and a tightening market as a result of production curbs by Saudi Arabia and the OPEC+. The widening gap between supply and demand, as well as the most recent industrial output report from China, which revealed faster than expected growth in August, helped oil reach its third week of weekly gains on Friday. Market participants and analysts have become more bullish on oil as a result of one of China's most recent governmental initiatives to kickstart the economy. China reduced the bank reserve requirement for the second time this year last week in an effort to boost system liquidity. The optimistic elements that support the upward trajectory of the oil market are China's stimulus program, the resilience of U.S. economic indicators, and the continuous supply reduction by OPEC+. To anticipate market changes this week, Tina Tang, a market analyst at CMC Markets, wrote in a note, "After a third week of rises, crude prices are not experiencing the customary profit-taking as the short-term petroleum demand forecast benefits from strengthening U.S. and Chinese economic data," according to Ed Moya, senior market analyst at Oanda. The oil market will remain tight for a bit longer, but Moya warned that we might need a new spark to push oil to triple digits. What are your thoughts on Saudi Arabia and OPEC+, and do you think they can overthrow the U.S. economy? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.